We're going to analyze Wells Fargo Bank. First, let's take a quick overview of the numbers, and then we'll go deep into the financials. Now, this is entertainment purposes only. I am not a financial advisor. When I started researching, the price-earning ratio was about 9.31. And if we look at this chart, this is JP Morgan. They took a landslide of about 30% on February 17th. When we look at Wells Fargo, they also took a landslide on February 17th, but it was down to almost 40%. And they also had a little bit of a dip before February 17th. So you can already see, just based off of the chart, that Wells Fargo is just not doing as well as, let's say, JP Morgan. Now, in terms of the stock price history, you can see in the 2008 crisis it went as low as $10. Will that happen again now? Well, it's hard to say. Back then it was a bank crisis specifically, so maybe that's why. Is it always possible? Yes, and it's a good indicator to know, but it's probably less likely unless things take a horrible turn. Now, in terms of revenue, you can see that it's been steadily going up and up, which is really good. In terms of net income, sadly, it hasn't been going up and up. It's mostly been above $20 billion, except for last year it was $18 billion, and we'll get into that. A major part of that seems to be legal expenses. Now, in terms of the price-earnings ratio, you can see there's a big stock price that dipped, the earnings dipped in the middle, and so the price-earning ratio took a little bit of a hit, and you can see it's looks like it's a little around 10, and we know it's around 9.3. In terms of the history of the past 12 years, it's mostly been above 10, so it is a good deal now. Is it an amazing deal? No, it doesn't go extremely high usually, but it is still a good deal. Now, in terms of 2008, we can't use the indicators of price-earning ratio over there because you can see the stock price took a hit, and so did the earnings, and so the PE ratio is a little bit all over the place, so a little bit hard to compare to that crisis. Now, in terms of the dividend, you can see on top the stock price took a dip. The payout amount is about $2, and so that's still steady. They say they're not going to cancel it, and it's around 7% yield. Now, in 2008, when we saw this massive jump in terms of the yield, we see that the payout, that middle graph, steadily went down and down and down. However, it did come back 5 years later. So will they cancel it? Hard to tell. Now, in terms of if we look at some of the specifics, it's at $2.04, the annual dividend. You can see below that it's about 7%, 10% growth. In terms of the last year's earnings, it was, 50% payout ratio, which is good. It means 50% of the earnings were only necessary for the dividend. Not amazing, but not bad. Now, in terms of this year's estimates, talking about 230% of the earnings going towards dividends, that's not feasible. Certainly not on the long run. They would have to take out a loan. But, will they cancel it? I don't know. It depends how long this crisis really goes and how accurate these estimates are. Either way, in terms of the next year's estimates, we're talking about 80% payout ratio. That's a lot better compared to 230%. And so, even if they do cut the dividend, it's very possible that they bring it back very fast. Now, let's look at the risks for Wells Fargo. Now, I have this article from Bloomberg, really interesting. It's about the new CEO, Charlie Scharf, and things that he mentions, the $1.5 billion of litigation. He also mentions that he's still new, and of course that his focus is regulatory issues. So right off the bat, we have a few just things that stick out. We have litigation expenses being quite high, something that he's going to mention, the fact that he's new, of course, and that his main focus is the regulatory issues. That's what he sees as the biggest issue, and that makes sense. We'll talk about that in a little bit. Now, in terms of the 10K, what they mention is that they don't hedge all their interest rate risks, and so if the interest rates fall faster than they assume, they're going to lose money on debt securities, and I assume that happened. In terms of another thing they mention is the OCC, which is the Office of Comptroller of the Currency, that they downgraded the CRA rating due to 2009-2012 issues, and so there's going to be regulatory restrictions on non-banking activities, so think about mergers and acquisitions, those types of things that the bank can't do anymore, at least not with a regulatory approval, and so that's going to take a little bit of a hit and another piece of red tape. Now, in terms of interest rates falling and mortgages, well, they're going to see people refinance. They're going to see prepayment increases. So on the one hand, that means they're going to get less money out of the loan over the long run. However, on the bright side, it means in the short run, people have to pay a fee just to refinance their mortgage. So the bank will get some money up front, small, very, very small percentage of what they're losing, I suppose. Now, they also mentioned that their mortgage servicing rights will decrease. However, it's good to know that we're only talking about $13 billion there, so I'm not going to worry so much about that specifically. Now, here's the main problem, and that is the Federal Reserve Board has an asset cap. That means that Wells Fargo cannot, make more loans than they currently really have. Otherwise, they're going to have too many assets on their balance sheet, and the Federal Reserve is limiting them due to all the legal issues they've had. And so, for example, let's say they have to submit something for oversight and compliance. Well, they have to wait for this third party to review that it's complete, the complete plan, I should say, and approve it and make sure that it's implemented to the satisfaction of the Federal Reserve Board. So just major red tape. And so what I had thought, and other people had expressed this idea, is, under this crisis, there's going to be possibly a little bit more wiggle room for the Federal Reserve. Maybe they'll even remove all this regulatory restriction. Why? Because the bank is going to have to make loans to customers to help them with liquidity. It's going to have to help companies, people. And so the Federal Reserve will have to be a little bit more lax. However, looking at all of these checks and balances, and especially, they mention also that even after the removal of this asset cap, there's going to have to be a second, third-party review. It's a little bit hard for me to imagine the Federal Reserve Board, just immediately removing and dropping all these regulatory issues and the asset cap and the overview. So will it happen? Yes, I think eventually it will happen. And so if you're in the stock for the long term, I'm not so concerned about it. In the short term, though, I wouldn't expect them to just all of a sudden drop all of these regulatory issues. Now let's take a look at the 10K. There's definitely some interesting stuff going on here. On February 11th, we have an announcement that there's going to be a new organizational structure to the whole bank. And that's, to me, is the sign of the CEO taking control, taking the reins. Now, maybe this is just a facade and not a real thing. I don't know. If you're cynical, that's the way you look at it. But I'm going to look more optimistically and just assume that this is the CEO really trying to revamp even the whole company. Now, in terms of revenue, not great. It's down about $1.3 billion from the previous year. Interest income fell down $2.8 billion. However, non-interest income went up $1.4 billion. So we kind of see this balancing. In terms of the credit results, so their net charge-off rate, so people defaulting on their loans, that stayed flat. There weren't more people defaulting last year compared to the year before. And so that means that at least the bank wasn't having issues before the crisis with people defaulting. Now, they also have a decreased loss in their automobile portfolio. However, increased losses in their credit card portfolio, which is not great. And their commercial portfolio kind of had a change of $130 million. Not such a big deal, in my opinion. Now, in terms of revenue, we can see it's $23 billion, and it's steadily going down. And then 2017, we see a little bit of a bump up in net income. Net income. And then it's steadily going down again. And we kind of see that over here in the chart, net income going up and then going down. And not great, as we mentioned before. Now, what's happening here? So we see a little bit of the numbers broken down that from 2014 to 2017, we're actually getting a lot more net interest income. However, that it flatlines in 2018 and goes down in 2019. Then non-interest income, that is kind of steadily going down. And that, I think, is the bigger problem, possibly. And nevertheless, in 2019, we see a little bit of a bump in non-interest income, which is nice. I don't know if that's foreshadowing more non-interest income going forward. Nevertheless, another major problem is we can see in 2014 to 2017, almost an $9 billion increase in terms of non-income, non-interest expenses. And so that's a little bit scary. And although it dropped in 2018 by $2 billion, it bounced right back up in 2019. So we're going to have to look at that non-interest expense and see what's going on there. Now, in terms of loans, kind of see that being stable, and that's probably because of the asset cap. In terms of the allowance for loan loss, so how many loans do they expect to default, we see that steadily going down year by year. And so if you're cynical, you're going to say, hey, they're not being fiscally responsible, they're not putting money aside, this is not a good sign, red flag. However, if you're more optimistic, it means the bank sees their loans performing well. Either their customers are stronger or just the type of loans that they are offering are constantly getting more likely to be repaid and less likely to be defaulted. And so that's, in theory, a really good sign. Now, in terms of deposits, we can see it's steadily growing. There's a little bit of a dip in 2018, but it bounces back in 2019. So I think that's pretty positive that people are putting more money into the bank. In terms of long-term debt, not great. It seems to be steadily growing, although they did pay off about 10% in 2017. Nevertheless, there's still $250 billion worth of debt, so a long-term debt, I should say, so that's not great. Now, in terms of non-interest income, just some interesting things. We can see that deposits get around $5 billion, although it's going down. Mortgage banking, the non-interest part of it, is steadily going down year after year, it looks like. In terms of insurance, we see that that's going down. Now, in terms of net gains from equities and securities, so I think of almost like stocks, we can see that bumped up. And in terms of other, which is hard to figure out what is this other non-interest income that they kind of lump together, it seems to be going up quite steadily. So it'd be nice to know what is that. Now, if we look at a table that breaks it down a little bit more, we can see the mortgage banking is going down. And specifically, some of that servicing income is going down. Now, we mentioned when people refinance their mortgage, which might actually happen in this low interest climate, people are going to refinance and they're going to have to pay a service fee. And so that might be specifically what we're seeing here, that people weren't refinancing. Now they might, and so that service income might actually get a nice big bump up in the coming year. Even though that mortgages will get less money due to the interest rate over time, nevertheless, people, due to servicing their mortgages, will get the bank will get a little bit of a bonus here, I suppose. Now, still, we see all other is still steadily going up, and it's not broken down much, except they showed us that life insurance investment income, which is pretty steady, was part of that other category before. And so all other is obviously breaking up a lot of things, and I looked through the 10K to try and find everything, and I found a few things. So first of all, they mention PCI loans, so those are purchase credit impaired loans, people who were likely to default and the bank bought them at cheap, so they are able to sell them to third parties, make money off of that. Equity method adjustments, so if they're invested in a company and that company does better, their equity will increase. Also, they closed the sale of their IRT business, which is their institutional retirement and trust, think 401k and pension plans, and that happened in 2019. So that's not necessarily reflecting all of those non-interest income. So this will be added over there, and they mentioned that they get a fee for administering the clients until the transition period when this new financial bank takes over. They also mentioned that they have gains and losses in LHFS, which are loans held for sale, and that's also included in other non-interest income. So quite a few different things that make up all other interest income, and it's hard to tell which ones go up, which ones go down, but I suppose it's a good sign that they're going up year after year. Now, in terms of non-interest expenses, we mentioned that there's quite a large growth, about $9 billion in a short time, and so I pulled up this year and pretty much from 2013 to 2015 to get an idea. And we can see that salaries are kind of growing year by year. And there's a $3 billion difference between, 2019 to 2013. So quite large. And in terms of incentives, employee benefits, a slight growth, but not much. Now, the thing that bothered me a little bit are these incentives. Warren Buffett, Charlie Munger mentioned, and we'll talk about it later, that the incentives for banks to reach certain milestones and for employees to reach certain milestones were causing these employees to take advantage of their customers and force sales and cross-selling. We'll talk about that, but it's a little bit scary that this number hasn't necessarily been going down. So I'm a little bit nervous about that, and it might mean that there's still bad incentives, or maybe they're just using the incentive money more wisely to avoid that. Let's hope so. The other thing I noticed that core deposits and other intangibles consistently going down here. Now, they mentioned that it's mostly due to this 10-year amortization of Wachovia intangibles. So it's very possible that this will disappear going forward. And that's a good thing. Now, what we see here in 2013, operating losses is less than $1 billion. And yet in 2019, that's $4.3 billion of operating losses. So that's a little bit scary to me. However, I found in the 10K, they mentioned that $1.2 billion of that change was specifically higher litigation accruals, so paying for lawyers pretty much. So in theory, due to all the lawsuits, when all these things go away, these expenses, this $3 billion change in expenses might also get seriously reduced. And this also might make up for the outside professional services being increased, about $2 billion, might also be, paying for accountants and other people to go over all of, their papers and things like that for the Federal Reserve that they now need for regulatory information, things like that. Nevertheless, we see about a $10 billion jump from 2013 to 2019. Not great, but a good chunk of that might go away. Salaries and things like that, those will not go away. So, some of these expenses for sure are going to stay around, but some of them have a very good chance. Half of them have a good chance of going away. Now, in terms of revenue, we can see that last year, 2019, is $85 billion, but the year before was more, 86, and the year before that was 88, so not great news there. And we can see from community banking and wholesale banking, both of them were going up in previous years, so that's not good. That means each one of them has been hit. And wealth and investment management at least kind of stayed constant around $17 billion. Now, if we start looking at community banking, that's the type of bank that you or I would use, or small businesses that, less than $5 million, and the owner is the one making financial decisions. So if we take a look at that, we can see that it's, $47 billion 2 years ago, and then it's going down. And if we look at the non-interest income, though, between 2018 and 2019, although the revenue was going down, non-interest income kind of stayed the same. So what's going on? Well, we can see the net interest income is what was really going down. And previous in 2017, although there was a bump over there, there was also a bump in terms of non-interest income. So net interest income went down, non-interest income went up, and it made up kind of for that fact. And so you kind of see this balance between some of these numbers, and that's really important. And we mentioned this with JP Morgan, which had a little bit of a better balance between interest income and non-interest income. It's about 50-50. Here we're seeing that it's not quite 50-50, but they can kind of make up for each other in theory. Now, in terms of total non-interest expenses, we can see that it went from 30 billion to 32 billion. That's a pretty large chunk, but a big chunk of that was operating losses, and we mentioned that was possibly because of legal. And another one was personnel expenses, salaries. So we already talked about that at least. In terms of wholesale banking, so these are bigger companies, we can see the total revenue year after year going down, and net interest income kind of staying stable, actually. A little bit of a bounce here and there. It's mostly from the other income of the segment that's what I saw as the biggest change. And once again, that's probably made up of a lot of different parts. Now, in terms of net income, we can kind of see it bounces around here. 2 years ago at being about 10 billion, jumping up to 11 billion, then jumping back down to 10.5 billion. So not quite clear, because we saw the revenue continually going down, and yet net income kind of bouncing around. And we can see over here that income before income tax is, it's going down year after year. So what's going on? Well, we can see over here the income tax expense quite different between 2 years, over $1 billion, $2 billion difference from 2000 and I guess 17 compared to 2018. And they mentioned, that has to do with credits related to low income housing and renewable energy investments. So on one hand, in terms of getting the actual net income number, it's a little bit hard to guess, because you can see that taxes play such an important role here. Nevertheless, a little bit scary that the income before you factor in the taxes was going down year by year in this segment as well, although not massively. Not such a big deal compared to 2018 to 2019. You're only talking about $500 million difference, but nevertheless, something to keep in mind just as a trend. Okay, so let's talk about loans, because this is going to be a major issue in this crisis. People defaulting, not being able to pay back loans to banks. That's where I think banks are going to have the biggest hit. Now, I saw that when they mentioned purchase of credit impaired loans, they only have $500 million. Well, the year before that, they had $5 billion, but they sold $4 billion of that mostly to pick a pay. And so that's really lucky. That means these credit-impaired loans that the bank bought, which were likely to default, they got a lot of them off their hands. And so I think that's really positive. Now, in terms of mortgages, those are going to be the major thing in terms of consumer loans. I can see $300 billion of that, and another 10% just about for junior loans. And what does that mean? Well, as far as I understood, that means, let's say someone defaults on their house mortgage. Well, Wells Fargo comes second or third or whatever it is in line. There's someone before Wells Fargo that will collect and try and sell the house and make back their loan before Wells Fargo does. But on the bright side, only $30 billion there. Now, credit card, which is quite scary. That's one that I think people would more likely to default on compared to mortgages. But luckily, it's only at $40 billion, so that's actually pretty positive. And you can see the commercial area is $515 billion of loans compared to the consumer, which is also around $445 billion. So a nice balance there, I suppose. Now, in terms of the commercial industrial loans, if we see them broken up, we can see that a lot of it is in the financial sector, about $120 billion. Luckily, a small amount, $20 billion in retail, less oil and gas, $13 billion, and even less than that, transportation services at $11 billion. Those are kind of the ones that scare me, and financials not so much. Either way, Each one of these segments, besides financials, represents a very small amount of the total loans, and even financials is only 12%. So I think that's actually a pretty positive. Now, in terms of commercial real estate, we can see that California's taking a big chunk here at $36 billion. But that doesn't concern me so much that it's concentrated there, because when we look at, the breaking, has these things broken up, a big chunk of that is office buildings, which I don't see defaulting as quickly as some other areas like shopping and hotels. Now, that's still $23 billion, but, it's not a massive amount, it's not a small amount, but it is something to be concerned about nevertheless. Now, in terms of consumer mortgages, we can see a major part of this, $126 billion, is in California, and another $33 billion in New York. So if you're expecting some sort of housing bubble or a housing crisis specifically in California, if you know about that type of thing, you can see that the commercial and the consumer are very focused in California. Now, a number of banks, I'm sure, are, because it's a very expensive area right now, and we saw JP Morgan was exposed quite a bit there too. Now, if we look at the total commercial non-performing assets, we can see it's around $2 billion, $2.5 billion, I don't know. But nevertheless, total consumer is going down year after year. And so that's a really good sign. That means that there's fewer people defaulting. And we see a lot of that has to do with mortgages going down. Now, similarly, when we look at troubled debt restructurings, so, the bank helping someone who's having trouble, we can see that's going down considerably as well year after year. And to me, that's positive. Credit cards going up a little bit, not much, but it is good to notice that these things, or the trends. Main point is, when we look at total troubled debt restructurings, it's going down year after year, and I think that's really positive. And from my perspective, when we're looking at this, it really shows that when we said at the beginning, they're putting a lot less money aside for, losses, well, this is probably why, because the bank is seeing their loans performing better and better year by year. There are fewer people needing restructuring. There's fewer people who are defaulting year by year. And so, to my mind, this is a really positive thing for the bank. And it kind of shows, it's hard to tell. Is it the consumer being more, powerful in terms of their ability to pay back? Or is it that the loans themselves are stronger loans? I'm somewhat leaning towards stronger loans, but it's hard to tell. Now, when we look at the allowance for credit losses, we can see that, of course, real estate is going down. And once again, a little bit scary that credit cards are going up. Now, there's only $40 billion borrowed on credit cards, and we already have allowance loss of about $2.5 billion, a little bit less. So, that's a good chunk of credit card being already reserved for. Nevertheless, still scary. Now, we mentioned this before, that when there's a decline in interest rates, people are going to increase their mortgage originations. They're going to get more mortgages. More clients are going to come to the bank to get a mortgage because it's going to be cheaper. And there's going to be more servicing fee income, specifically because people will refinance. Something to keep in mind once again. Now, in terms of commercial unfunded credit commitments, so how much more could a company borrow from the bank? Well, most of this is $350 billion. That's a massive chunk of it. And in terms of the consumer, a little bit scary. A massive chunk is credit card, $115 billion. So that's another 3 times what people have on their credit card now. So a little bit scary that so much can be borrowed, but nevertheless, not a massive amount in my opinion. Now, when we look at the allowance for credit losses, we can see that it's going down year by year, which we mentioned before. The provision for credit losses changes every year, but it's around $2.5 billion. And how much is being lost from commercial? Well, that's a little bit less than $1 billion, so not much fluctuation there. And like we mentioned before, credit card year after year, it's going up. Now, what I think is positive is that the net loan charge-off, so how much are people defaulting just at the end of the day after recoveries and combining all the different areas, it's a little bit less than $3 billion. That's not an enormous amount of money, and it's very stable. I think that's a really positive thing. And once again, the balance at the end of the year in the reserve is going down year by year. Now, if we look at the customers specifically on FICO rating, and I think this is a little bit important considering the situation the world's in right now, we can see, first of all, that 670 to 739 is good. And so when we start looking at the FICO ratings here, we can see less than 600, only $14.5 billion, not a small amount, but also not a large amount because 600 goes all the way down to 350, so that's quite a range there. And 600 to 639, we're talking about $11 billion there. And then in that better range that we talked about, that good range, this is pretty close, 680 to 720, we can see a good chunk of credit card and automobile. This sector has the highest combination there. So, the highest sector of credit card debt, let's call it, to the bank is still in a good FICO rating. And so I think that's positive. It's not the best FICO rating, but it's still good. And in terms of mortgage, you can see the best FICO ratings, 800 plus, that takes up a significant amount of the mortgages and the junior mortgages, so where Wells Fargo is second in line. So that's, to my mind, really positive information. And you can see on the right here, as we look up the FICO total scores, as they go up, they get larger and larger amounts of loans. And so that makes a lot of sense. And I think that's really positive. And the 800 plus takes up the biggest chunk of consumer loans, at about $200 billion. That's about half. So that's to my mind, pretty good. Now, when we look at country exposures, we can see that United Kingdom is the biggest one at $31 billion, give or take. Not great with all of this Brexit stuff, but also not too bad in terms of foreign countries. We see Canada is second. Also, that's a pretty positive country, I think, in terms of everything going on. Now, luckily, China, they're only at $4.5 billion. They might see a lot of tariffs or a lot of people fighting back in terms of economic sanctions, things like that. So luckily, the bank is not exposed in a large amount over there. How does this exposure, really add up? Well, most of it is to the companies themselves, $70 billion for their businesses and things like that. So a little bit scary, but nevertheless, something to keep in mind, that this is a small portion of, the $500 billion, give or take, of commercial that the bank has within, the United States. Now let's look at the first quarter results, and we'll see what's going on here and try and get an idea compared to the 2019 10K. Okay, so first of all, they have 90-day suspensions for home lending, people who need help. There's not going to be foreclosures and evictions. There's not going to be auto repossessions. And so, this is going to be good for the clients and the bank. First of all, the clients, people who are having difficult time paying off their credit card or their auto loan, they're going to get a little bit more time. They're going to hopefully get a job. Things will clear up. They'll be able to, some people, hopefully most, will be able to pay back the bank and won't be a major issue. But it's also going to be good for the bank. Why? Because there's a lot of people who would default right now. Nevertheless, the bank can kind of extend that. They don't have to deal with it right away, right now. They can kind of extend and delay all these defaults that are happening. And so the bank can prepare themselves. They can take out loans. They can put more money aside for reserve. They know what's coming down the pipe, and presumably, and they can really get a little bit of a better handle on it. So good for both. Now, they mentioned that there's $80 billion of their loan commitments went through. That's a massive amount of money. The bank is also looking at ways to help customers. So they mentioned, a certain type of account that doesn't have overdrafts or insufficient fund fees, or, for example, some account that maybe has fees at once per month, but they don't get charged more. And that's really good, because the people who get these type of fees are probably people who don't have money available. So it's good to be protected, for them to be protected. Of course, it means the bank might get less money from fees, but I still think it's a very positive thing from my perspective. Now, they talk about raising the minimum hourly pay, and from $15 to $20, and that's for 20,000 employees. So we were talking about all those salaries increasing. So once again, we're going to see another salary increase as well. Now, they mentioned some things that I think are really good, both for minorities and for the bank's, public image, I think. $50 million to African American minority depository, and also for DACA recipients, they're going to, do some things to help them. So once again, I think all in all, positive outlook there. Now, they mentioned that they have $4 billion of provision expenses for credit losses, and they lost $1 billion due to securities impairment. Now, when we look at the net interest income, it's up $112 million. That's impressive, because interest rates have been going lower and lower, but it's because of a hedge, so that might not continue through. Nevertheless, non-interest income, sadly, was down $2.3 billion. That's a lot. However, non-interest expenses was down even more at $2.6 billion, but a major chunk of that was legal litigation accruals that went down $1.5 billion. So once again, as that goes away, that will be a very positive thing for the bank. Now, in terms of loans, talking about up $47.6 billion. Massive amount of that is specifically commercial loans at $52 billion. And most of those were deposited in the bank. You see $53 billion was increased in the bank deposits. And so that's a good sign. That means these companies are taking out the money. They don't necessarily need it right away. They're not defaulting. There's not something crazy, but they might need it to give them some wiggle room. Short-term borrowing for the bank is down $12 billion due to the asset cap. Not a great thing when all these regulations are affecting what the bank might actually do, like borrow short-term money that they might need. So a little bit scary there, of course. Net loan charge-offs are at $900 million, but that's only up $140 million from last year. So, my perspective, that's good. Although, once again, we have that 90-day delay, so we don't know exactly what's happening here. Now, in terms of average loans outstanding, we see the yield is going down. Some of that's going to be from refinancing in terms of the lower interest rates, things like that. Credit card, we see that compared to last year, the volume is only $300 million up. However, it's $2.4 billion down from last quarter, but they say that has to do with seasonality and fewer new account openings. So, that to me is good. In terms of financials, we see that's still the highest part of the loan segment here, and that's at $126 billion. Retail, I think it was $20 billion, now it's $27 billion, so a big increase there. In terms of entertainment and recreation, that's still pretty small, $16 billion. Oil and gas, still small, $14 billion. Transportation services, still small, $12 billion. And here in the Q1 report, they actually really broke things down, which I think is good. So in terms of real estate, we see 14% is food, drug, and beverage stores. That's pretty well, they're doing quite well still in this crisis. Now, sadly, when we're looking at all the other areas, all the other areas of this $28 billion, I'm not saying they're all going to default or anything like that, but they're all going to have a lot of trouble, sadly. Now, in terms of oil and gas, I'm really not an expert, so it's hard for me to tell, but once again, I would think that all of these areas might have a little bit of trouble during this oil crisis in terms of price being so cheap. Now, in terms of entertainment and recreation, a little bit better news here. Amusement parks, that's 1%. Cruise liners, less than 1%. So those are, areas that are really going to be hit hard. So very small segment there. Gambling industry, well, they're also hit hard. However, Las Vegas and these places are really trying to figure out a solution, so that should be good. But a massive 70% is sporting goods, boats, RVs, motorcycles. These areas very likely never closed or will be able to reopen quite easily. In terms of transportation services, also good news. Air transportation is only 20%, and keep in mind that there's still a whole area of freight air transportation. I don't know what percentage this is, that would be of this, but, it might still be some of it in theory. Nevertheless, truck and transportation warehouse, which is a massive amount of this, that's still going business as usual. In fact, who knows, maybe business is even better. Now, when we look at some of these areas, so credit card outstanding, we can see that's really not changed so much. So people aren't, like I said, consumers aren't going out and putting out massive amounts of money on their credit card. I think that's good. In terms of net charge-offs, not much of a difference here. Maybe it's up $20 million. That's, that's not scary at all in terms of people defaulting on their credit cards. In terms of total loan charge-offs, we can see not up so much, just $200 million, just about, maybe a little bit less, 150. And we're going to see a very small amount in credit card, it's $40 million. The biggest amount is commercial and industrial, which is a $150 million change compared to last quarter. But once again, all these things could be very well could be delayed. So we're not really seeing the full effect yet, which is, on one hand good, on one hand a little scary. Now, in terms of the earnings call, we'll go really quickly. They mentioned that they're seeing this whole crisis it's not going to be a quick V or a quick U. So it means they're looking at things as more of a negative kind of picture. And I think that means they'll be, better prepared. Now, they also mentioned the fact that they can't get all these new loans. Why? Well, because of the asset cap. Now, the positive of that is that, other banks might make themselves and their balance sheet look good, even though it's not the right thing for the bank, just to get more loans, just to try and make up for what's going on in terms of the balance sheet of the bank. So on one hand, a Wells Fargo can't act, irrationally, just, the positives for the short term and take a negative approach for the long term, like some other banks might be able to do. I'm not saying any bank is, and neither are they. So, that I suppose is a positive, but once again, it's a little bit of a negative, these regulatory issues. Now, they also mentioned the fact that $50 billion that was drawn down in terms of loans Most of that was in March, and it's not really sticking around that pace. It was just a massive spike, and then it kind of went away. So that's a good sign. We'll have to see what happens. Are companies gonna need more liquidity or not? Okay, and the next part of this is going to be the legal stuff. Now, I'm going to stop right now, and I'm going to split up this video into separate parts because it is just so massive and there's so much going on. I don't want to make the video too long because I think people are having trouble watching the whole thing. But you let me know what you kind of like. What am I doing right? What am I doing wrong? What would you prefer? That would be really helpful for me, even if it's negative. Try and make it, constructive, I hope. But either way, it would be good to know. And just let me know, leave comments, subscribe, and thumbs up. That would be useful. Thanks.